welcome to Indianomics. For the fourth time in the last 15 years, financial markets have been faced with a familiar question. Should participatory notes be phased out? Well, I have with me a star panel to discuss this. Former SEBI chairman, Mr. M Damodaran, who in his time had tried to phase out participatory notes. Mr. G. Padhmanaban, the former executive director of the Reserve Bank of India, the central bank which fought the P notes tooth and nail when they became a common market practice, and Mr. Pramod Gubbi, the head of institutional equities at Ambit Capital. But before we come to the discussion, let me lay out the terrain. Stock market indices fell nearly 2% on Monday last after two words, participatory notes, touched headlines over the weekend. A special investigation team of the Supreme Court, entrusted with the task of suggesting steps to curb black money, identified participatory notes as one source of black money and recommended that market regulator SEBI should do more to identify the real owners of these notes. Now, what are participatory notes? Participatory notes or P notes are offshore derivative instruments used by foreign investors who are interested in betting on Indian shares but not keen on registering with SEBI. The overseas investor goes to a foreign brokerage registered with SEBI or to a foreign arm of an Indian brokerage and tells them to buy the shares he wants. The brokerage does so in its name and against this collateral sells a note to the overseas investor at the price of the share plus service charges. While some pension and hedge funds abroad use this route, many experts say Indians with illicit money stashed abroad also bring that money into India through participatory notes. To prevent detection, they do this through layers of holding companies or customized funds. RBI and SEBI have therefore been uncomfortable with these instruments. RBI had issued a written dissent on a paper and P notes in 2005, and in 2007, the SEBI had banned further issuance of P notes and sought to grandfather existing ones. But the move was stopped after the Lehman crisis. Since 2011, SEBI has started a renewed effort to force P note issuers to reveal a lot of information on the buyers.
एसआईटी ने ये रिकमेंड किया है कि पी नोट का जो कौन इन्वेस्टर है, अल्टीमेट इन्वेस्टर, उसकी जानकारी रहनी चाहिए सेबी के पास। और मैं आपको ये बताना चाहूंगा कि 2011 के बाद हम लोगों ने काफी चेंज किया है और हमारे पास उसकी जानकारी है। यदि और उसको सुदृढ़ करना होगा तो हम करने को तैयार हैं।
The Supreme Court's investigation team, however, believes that even now, the end beneficiary could be different from the first P note buyer, and hence the direction to SEBI to get to the final individual owner. News like these disturb markets because the outstanding value of P notes is 2.75 lakh crores or 11.5% of total FII holding in India. This is less than in 2007, much less, when outstanding P notes amounted to 4.5 lakh crore rupees or 50% of FII investments in India. Yet, even today, any move against these notes triggers selling in the markets. The questions we are asking: 1. Should P notes be phased out given the global move towards transparency? 2. Can they be retained and made more transparent? 3. Can these moves disturb India's financial markets unduly? And 4. If P notes are banned, will they appear in another form? Well, welcome to the show. I have with me three eminent people to discuss this issue. I have with me Mr. M Damodaran, former chairman SEBI, who in fact had started the first moves to phase out participatory notes. I have with me Mr. G. Padhmanaban, former executive director with Reserve Bank, and who knows why Reserve Bank was in the first place adamant about stopping participatory notes. And I also have with me Mr. Pramod Gubbi, the head of institutional sales at Ambit Capital. He's joining us from Singapore. Gentlemen, thank you very much for joining me. Well, Mr. Damodaran, let me start with you. Do you think that even without the problem of black money, the very fact that we are asking Swiss banks not to encourage, the practice of hiding the names of customers, we have no moral right to continue with these notes?
The SIT said that the market regulator should know who is investing in the market. You should have that information. Because in the absence of information, clearly there is a possibility of black money generation, and that is the subject that the SIT is addressing. That is where the SIT's concerns come from. Now, if you look at the history of this, 92 you started seeing offshore derivative instruments. It continued without any check. In 2004, SEBI said, enough is enough. We give you 5 years' time, you wind down. Far from winding down, it increased to fairly high numbers halfway down that 5-year period. And therefore, in 2007, SEBI said no fresh issue. And you get till 2009, which is your original timeline from 2004, if you count 5 years, to wind down. It was intended to be a non-disruptive way of phasing out a non-transparent element from a market where the international community is asking for transparency. You're seeing evidence of it worldwide. So do you really need this instrument? And my take on this has always been, if India is a growth story and people are investing in India because it's a growth story and you want to buy into the growth story, register with SEBI and invest.
Okay. Pramod, let me start at the beginning. In your estimate, who are the people who use participatory notes? Since at the moment, almost 90%, 88% of the foreign investment is happening through the FPI or the FII route. Who are the kinds of people who prefer this 11% that come through the participatory notes? Are they largely pension funds? What kind of people are they?
They would largely be investors across all spectrums, but certain hedge funds would be the majority. Hedge funds who operate across different markets, for whom getting registration in specific markets might be a cost of doing business. It's simply to avoid that, they would engage with a certain P-note issuer across multiple markets just to keep it simple from a transaction perspective and get access to that market. So there is nothing malignant in that, in the intention there. Irrespective of the nature of the fund, whether it's a pension fund or a hedge fund, my sense is it's the majority are hedge funds who are quite nimble, by the nature of their operations itself. They would want to keep it simple in terms of ease of transacting in multiple markets.
That's one category.
At the same time. That's right. There is a category of hedge funds who also operate across multiple markets, but some who genuinely choose, even if they could have taken an FI or an FPI route, intentionally choose a P-note option, like I said, to keep their identity anonymous when their identities are well known by the market, and their transactions, when made public, can move prices and can have their own can have a price impact on their own position building, which is why they would opt to come through P-notes. These are again with genuine intentions. There are other markets globally which provide this anonymity to investors who genuinely want to build positions at very low market impact. The last one, which is what the SIT seems to be intending at, is where the source of the money is perhaps not completely above board, either through tax evasions or other purposes, who choose to sort of get into financial markets through these structures and genuinely want to keep their identity anonymous. I think it is the small minority of such investors which is what the SIT is after.
Okay.
The majority of P-note issuers are largely all right, even from the court's perspective.
Okay. Mr. Padhmanaban, the RBI grapples with the NDF market, but you can't stop it. So do you think that structured products in some form will survive? If you phase out P-notes, then they are likely to continue as structured notes by another name, and it will not even be told to the regulator.
Okay. Now, the first, let me start by putting across what was Reserve Bank's concern way back when we said, in fact, gave a dissent note to a committee set up by the government as to why P-note should be discouraged. Basically, in any kind of market, for maintaining the integrity of the market, there are three things which are important. First of all, which is becoming a big issue today, is the beneficial ownership known. That's number one. Second is the question of market manipulation. So the market manipulation you tackle, the regulators tackle through a near real-time monitoring. Is that real-time monitoring possible as far as the P notes are concerned? And the third issue, which is probably specific to India, more of a concern, is the round-tripping issue where this tax evasion happens. Now, at that point of time when Reserve Bank of India objected to this, I think the international scenario, the international rules and regulations were such that possibly all these concerns were genuine concerns. Now, the question that we need to address today is whether we have been able to address this concern a little better through various methods. And the second is, if we try to do anything to the existing market structure, will the market structure take as such, or more because we have internationalized more, the international investors will find some other means to come back into the country through some other instrument. Call it P note, call it something else. I think one of the lessons that we actually learned as far as the currency is concerned, which was your question, is that probably we need to take measures to make sure that these investors, the point which Mr. Damodaran made, have access to the Indian market more directly, easily, less documentation, less formalities, and let them come in directly. And that possibly would be a better option to tackle this entire issue than trying to tackle through any kind of artificial restrictions.
Okay. Well, at this point, let us take a break. Thereafter, we will also play out to you what SEBI chairman had to say on the matter. We're back in a minute.